All right, everyone, welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
And today we've got an extra special guest here. It's been a while since we've had a guest,
I
but
know.
Yeah.
we brought in Zach Kill, who actually joined us a handful of years ago. I think it was during the pandemic. We were social distancing in the conference room with Zach, and we talked about, was it tax loss harvesting?
Yeah, I
Something
think
Um,
like
so.
that. That makes me feel really old though when you're like, we've been doing this podcast for years. I'm
we're
like, no
coming
way,
up on
because
7 years now.
ew, but
It's great.
yay.
Um, Yeah. Thanks to our loyal listeners and sponsors for keeping us going. And by sponsors, no one sponsors this, which is the way we like it. We don't want any
hmm
skewed biases here. But anyway, Zach, member of our investment team, chartered financial analyst, CFA, fancy initials. You had to study hard and pass a lot of tests over a multi-year span to get those credentials. So what that means is he knows a thing or two about investments. Part of his job at our company is evaluating the vast world of investment offerings and narrowing that down to find what is appropriate for our clients' portfolios and for given circumstances that our unique clients might need. And then we, as advisors, can work with our clients and our investment team to help determine what's most appropriate for them. Lots of different tools in the investment world. How do we use them all to achieve each of our clients' individual goals? There's a reason there a lot of things exist. There's certain use cases require certain types of tools. Just like if you work with a carpenter, they've got saws, they've got hammers, they've got nail guns, they've got measuring tape, the different tools for different tasks to achieve different objectives. So today, Rochelle and I will say some things. Zach will correct us and elaborate further on all these different investment vehicles and why you might want to use one over the other in certain circumstances. We're going to cover the most broadly used things today, mutual funds and ETFs. Why do they exist? What the differences are, what the pros and cons are. Talk a little bit about investing directly in individual securities and maybe some other advanced investing 301 strategies that can kind of dovetail off of some of these things. So I guess where do we want to start here?
We don't want to start at 301 because that's really complicated. So we'll start at investment 101, I guess, which I can cover.
Yes, I
Okay,
like it.
so just fundamentals. There's lots of different tools and things that you can invest in. Mutual funds and ETFs, which stands for like exchange traded funds. They are both like a collection of investments purchased with money that's pooled together from lots of different investors. And those investors can be like you and me, they can be retail investors, they can be institutions like banks or pensions, lots of different kinds of like people and institutions can invest in these funds. And then that pooled money is used to buy specific investments. And generally, the fund will have a stated purpose. Like this ETF is investing in these kinds of things. And it may be like large US stock companies. It might be emerging market stock, like, China, Brazil, places like that. It may be that it's a specific kind of bond or something like that. So as an investor, you get to choose what type of investment you want your money to be invested in, but then the fund itself determines like how that money is explicitly deployed and used moving forward. So there are some things that are similar about both mutual funds and ETFs, but there's quite a few things that, like when you get very granular, are a little bit different. So we're going to spend a lot of time today talking about some of those big differences or
Yeah.
small differences, I guess. They're very similar in a lot of ways.
For most of you listening, like the general concept, ETFs, mutual funds, it's a basket of different stocks or bonds or whatever they invest in. For most buy and hold long-term investors, doesn't really matter which one you use. You're not doing anything fancy. You're just investing in a diversified pool. Both can get the job done. But we'll, like Rochelle said, nerd out a little bit, get in the granular details, and talk about why one might make more sense than the other in certain circumstances. So, Zach, why don't you lead us off with some mutual funds? What is a mutual fund and how does it work? Why might you want to use it? Why might you not want to use it?
Yeah, I think that just as far as getting into the market, mutual funds are one of the simplest ways. With a mutual fund, you're getting kind of as Rochelle mentioned, you're getting a basket of securities. It's a one-stop shop. You just buy the mutual fund from the mutual fund company, and then you hold whatever it is that you bought. So it could be, the US stock market, international, certain sectors, and broken down like that. I think one of the main misconceptions with mutual funds is that all mutual funds are explicitly worse than ETFs, where generally speaking, when people talk about expenses or tax efficiency, there are two different kinds of mutual funds. There are active mutual funds and there are passive mutual funds. So, you could go with an active fund that might have a little bit higher fees, and that has a manager who's trying to beat the market. And typically, those are going to be it doesn't really matter that it's a mutual fund or an ETF or whatever it is. Those tend to be less tax efficient because they're actively being traded. For index funds, on the other hand, so you could still own an S&P 500 mutual fund or other indexes. Those tend to be low cost, and they're also more tax efficient. So one of the main things to know with mutual funds is that when you're buying them, you're buying it from a mutual fund company that packages it up for you, and when you sell it, you're selling it back to the mutual fund company. That's one of the main differences between mutual funds and ETFs, where ETFs typically they're created and then they trade on the secondary market. So you're not redeeming shares, you're just selling them to somebody else on the market. Does that make sense?
I think so.
Absolutely.
Yeah, so it's like the mutual fund company is like an in between, whereas with an ETF, you're just dealing directly with the market.
Hmm.
So yeah,
Yeah,
an ETF, kind of like a stock company issues stock. You buy it from some other investor who's selling it. You don't buy it directly from
the company
Apple or Google or Nike or whomever. Or yeah, mutual funds, you are transacting directly with that mutual
with
fund
Vanguard
company.
or whoever.
You give Vanguard money,
Hmm.
they give you shares in exchange. So essentially every time someone, assuming no one like in a given day, no one is selling, one person is buying, that one person gives the mutual fund company money, the mutual fund company creates new shares to give to that
Hmm.
person, and then with the cash goes out and buys more of the investments that it owns to satisfy
Exactly.
that objective.
Hmm. And that's one of the big differences too, is with the mutual fund, when you want to redeem shares, the company needs to either use new deposits or they need to sell to make the funds available to give you your money back. And so, when we talk about the tax efficiency of mutual funds, that is one of the downsides is that, potentially there are more capital gains built into them because the fund company needs to sell in order to get you your money back. It depends on the type of investment. I know that with a lot of index funds, especially, with Vanguard, they're very tax efficient. One of the ways you can tell the efficiency of a mutual fund is if you get capital gains distributions, where with a lot of these index funds, they really don't pay out capital gains distributions very often. So they are pretty tax efficient, but technically, an ETF just has that extra layer of not needing to do that.
Mhm.
And why do ETFs not need to do that?
Yeah, the main difference there is because ETFs trade on the secondary market, there's no transaction ongoing with the fund company. So, if iShares creates an ETF, they go and sell it, they package it up, they sell it to the market, and then, if I sell shares of an S&P 500 ETF, I could be selling it to Corey, I could be selling it to Rochelle, or anybody else out there. I'm not selling it back to iShares. And
And you
so they're
can't sell
they're
it until there's a buyer. Like it's like there
Mhm,
has to be a buyer in order for there to be a sale.
exactly.
So
Yeah.
iShares isn't buying or selling any stocks once they create the fund. It's purely you and I transacting with each other. So if no one bought or sold throughout the year, there in theory would be zero capital gain distributions in the ETF, assuming, the ETF didn't sell any of its holdings throughout the year. Um,
Hmm. Yeah,
so yeah.
the real difference, yeah, is that it just kind of makes it smoother for those interactions. One thing that with ETFs is you can exchange underlying shares, the fund companies can, and so that also helps improve the tax efficiency. Vanguard worked out a system. They patented this a while back, and I think the patent is gone now, but where essentially they pool the mutual fund and the ETF investments together, and so the mutual funds got the same tax benefits as the ETF. So there really was no distinction. But generally speaking, that is the difference: is that you with the ETF you can basically the shares can be kind of transferred between purposes within the account versus needing to be sold.
So like if a
Yep.
big institutional investor wanted to redeem some money, rather than selling out of those stocks, they might just transfer those stocks to the institutional investor and let the institutional investor do the selling instead, so that the
Hmm.
other shareholders aren't hit with that capital gain
Yeah,
distribution. Leave it to,
could
and then I
essentially
think,
create new shares.
yeah. So, and then same with like if a big institutional investor wanted to invest billions of dollars, it's like, well, why don't you go buy these stocks, transfer them
Hmm.
to us to add to our pot, and we'll create new shares with that uh, added basket of stocks. Um,
Exactly.
there we go.
Cool. I know another one of the big differences is when things trade. So with mutual funds, like if you request a distribution from your mutual fund company, you want to sell out of a fund, that sale doesn't process until the end of the day. And it's
Hmm.
like the sale processes at something called net asset value, which is basically the price at the end of the day. And everyone that sold their shares throughout the entire day gets that same price that's set at the end of the day. So you're not able to like trade throughout the day. Whereas with ETFs, because you're trading directly on the secondary market, you can sell at any point during the trading day and get like whatever the price is that you can get at that point in time. So
Hmm.
that's one big difference, which like we don't do a lot of day trading here. There's not a lot of like really exciting things going on, but that can make a difference for some people.
Well, let's,
Yeah,
yeah, go ahead, Zach. I was gonna say, let's dive
Yeah.
into that a
I,
little further.
I'd say functionally, I think one of the things that people make a mistake with is if you're trying to figure out what the market's doing in a given day, so you look up your mutual fund. So if you look
Yeah.
up, the S&P 500 mutual fund, the price that you see isn't today. That's yesterday's closing price. And
Right.
so, if you ever look at a mutual fund compared to anything else in the market, you're like, oh, this is trading differently. It's because it's yesterday. Where when you look up an ETF, that's live. That's within probably usually if you look it up online, it shows you 15 minutes delayed or something like that. But it's more of it's closer to live than a mutual fund
Hmm.
would be.
Well,
Right.
and then with mutual funds, because everyone buys and sells at the same price at the end of the trading day. Basically, they add up all the holdings divided by the number of shares. That's the price per share. So, from a, correct me if I'm wrong, but from a pricing standpoint, it's a little bit more fair, equal, accurate in a mutual fund. Whereas with an ETF, you've got to deal with bid ask spreads throughout the day. So, the sellers and buyers might not be getting the exact same price. There's going to be a little bit of a
Hmm.
discrepancy there for most of the ETFs out there that you guys would be investing in, non-issue. But for some of the lower volume, less traded, more obscure ones, that potentially could create some price discrepancies that either could benefit or adversely affect investors, right?
Hmm. Yeah, the major, ETF indexes, the bid-ask spreads are minuscule, but when you start to get into some of the more obscure asset classes, I know when cryptocurrency first kind of came online in its smaller forms, some of those original investments had basically you would have a premium or essentially you're paying more for the shares of the fund than the actual cryptocurrency is worth in the underlying. And so, theoretically, if that were to even out, you've basically just paid more than you needed to.
You're
Where
then better off
kind of
just
like what
buying
Corey
the
said.
crypto directly versus in the ETF.
Exactly. You're just paying a premium to have the wrapper on it. And so that is something to keep an eye out for. But like I said, in the major securities, you don't really need to worry about that too much.
But with actively trading throughout the day, we're talking about pros and cons here. We talked about how mutual funds a little bit more accurate at the end of the trading day, but throughout the day, especially if the market's going haywire, like you can put things like stop losses on an ETF or limit
Hmm.
orders to where like you can prevent, well, you could protect yourself from a major downturn potentially, or you could trigger a sale if there's a spike in price during the trading day. Whereas with a mutual fund, you can't do that. You got to wait
Hmm.
till the dust settles at the end of the day. So if market's down 12% in a day, like we saw some of those days during the pandemic, well, I guess if you wanted to sell, you're waiting till it's down 12%. You can't put a stop loss on there to trigger a sale when it's down 5%.
Don't sell.
Exactly.
That's the solution. But anyway, moving on.
I, I mean, with that in mind, I mean, I think that mutual funds tend to be they're easy to use. They trade once a day. There's not a ton of thought that needs to go into how you're going to execute the trade. Where ETFs give you more flexibility. You can trade it throughout the day. Like Corey mentioned, you can use stop losses and things like that. But it's more for people that are prepared to do those things. Where mutual funds are also fine in their own right.
Yeah.
Well, the nice
Yeah. And if
thing
you're
with
a
a
long-term investor, you're probably not messing around with a lot of that. Like if we're talking about
Hmm.
retirement plan money for when you're 60 or 65 and this is not your play money on the side, like chances are you just want to let it ride.
Yeah.
Well, and with
One of
mutual
the
funds, another easy thing is you can just set up an automatic dollar cost average. I'm going to deposit $1,000 a month and it's going to buy $1,000 worth of shares every single month.
mhm.
I don't have to think about it, don't have to look at it, don't have to make sure it works. It's just autopilot. Whereas with an ETF, it's not quite as easy to set a exact $1,000 a month purchase, right? Because you got to buy share quantities. So there's a little bit of math
Yeah.
involved.
Mutual funds are easier to split. I mean, just universally, they're easy to split the shares. And so, you can trade by dollar value pretty easily, and that's typically what people do. With ETFs or stocks, you need to buy by share quantity, and a lot of brokerages won't allow you to split shares. And so it really just comes down to what the share price is on the day that you're buying it. And so for ongoing contributions, mutual funds can be easier just because it's more of a set it and forget it. With the other thing there is with dividend reinvestment. Usually with mutual funds, you can just set it up for dividends to automatically be reinvested. Where with ETFs, you would probably need to do a drip program, which typically has costs associated with it. Also, at most brokerages.
So drip, what does that mean for us who can't spell?
It's essentially a dividend reinvestment program where it goes in and it collects the shares and will go and buy additional shares as you have
Enough
basically
money.
units available to do that. Yeah.
Yeah. Yeah.
And when you say there might be additional costs for that, so like some brokerages,
It'll
Schwab,
be,
Vanguard, Fairleigh, they might charge you a tiny price to set that up.
mhm. Yeah, exactly.
Should be pretty minuscule though, to where you won't really notice it at the end of the day, but it's
Yeah.
still there's a cost. And
It's just a little fussier in that regard, where I think it depends on how you're using the account. If you want those extra, like the dividends in cash so that you can buy different things with them, then great. But that is just something if you're, once again, mutual funds are great, set it and forget it, where ETFs tend to be a little bit more, there are more
Work.
options. Yeah, more potential work. But if you want to kind of fuss with it, then it can be better.
Do
for
you think that
client,
it leads
go
to
ahead.
sometimes there being more cash, like sitting on the sidelines? Because, like, okay, I don't have enough to buy 20 shares. I have enough to buy 19 shares, but I have this extra chunk of cash that's just sitting over there because I didn't get to buy my 20 shares. Like, do you feel like that happens sometimes? Yeah.
Yeah, I think that's a good thing to mention. With mutual funds, especially for smaller accounts, because you can do fractional shares, it's really easy to just, buy up the whole account and get it invested. Where with an ETF, I mean, a lot of S&P 500 ETFs have, the prices are roughly, $600 per share, 500, $600 per share. And
Hmm.
so if you're in between that, you end up leaving it in cash, waiting for it to have enough money to invest it. And so that
I
can be, yeah.
I do notice that when clients will send me an account that, especially with new clients that have an account that they've set up on their own, or if someone has a little play account on the side and they've bought some ETFs, there often is a little bit of cash in that account. Um, Maybe more so than you'd typically like to see, just because of those fractional purchases, and creates a little
Or
bit of a
maybe
cash
because
drag.
dividends didn't get reinvested.
Bingo. Yeah.
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 Whereas like for clients of ours, if you're working with an advisor, like our job is to handle all this
Do
stuff
the best.
for
Yeah.
you. So like we
Mhm.
can get that sorted out. We can get the cash invested. We'll get it into the right vehicles and tools, and get the
Hmm.
dividends reinvested. Like every day, Zach and his team are making sure accounts are appropriately traded and invested. So it's like for clients of advisors, it really is a set it and forget it either way. But if you're
Oh, for
doing
sure.
some of this stuff on your own, yeah, ETFs have some more capabilities, but also require a little bit more work and effort. Not a lot,
Hmm.
but a little bit.
Yeah.
Mhm.
So,
Uh,
Zach, what are some of the like really big pros on the ETF side? So it sounds like we've talked about some of the limitations and how it can be a little bit more challenging, but what
Yeah.
like Tax planning wise, I understand that there are some benefits, but I think I don't understand like the details of the benefits. Like, why does that really benefit people from a tax planning perspective and like their brokerage accounts and things?
I think the real benefit there is that you're not getting those capital gains distributions or less significantly less frequently that you're getting those. And so, if you're looking at taxes in a brokerage account, if you buy and sell the security yourself, so say you buy a stock and it goes from $100 to $200, you pay capital gains on the $100 difference. But in a mutual fund, what could happen is the stock or the mutual fund goes from 100 to $200, but during just without you selling it yourself, there are trades happening within the mutual fund, and those get distributed to you. The gains from that get distributed to you as capital gains or a different type of capital gain. And so that just creates a little bit more tax for you when you go to do your taxes based on activity that you didn't do yourself. And so
Yeah.
with ETFs, due to the way that they trade, those capital gains distributions are significantly lower. And so that can just help, over the long term. It just reduces the taxes a little bit.
Because the
Like I
ETFs
mentioned,
aren't buying
yeah,
and selling the stocks directly with you. You're buying and selling from another person
yeah,
on a secondary market. So really, it's the main or potentially only reason you might experience a capital gain is if you choose to sell yourself, whereas
hmm,
with a mutual fund, you may not sell and still get hit with a capital gain. The other thing,
yeah,
and this is, you might need to edit my words, Zach, but when we talked about earlier, like institutional investors, like rather than the ETF selling out of stocks, they just give the stocks to the institutional investor and let them sell it themselves. Like, can't they choose the lowest cost shares to pass on so it saves all the other shareholders and ultimately creates a higher cost basis for them? So if they were to distribute a capital gain, it would hopefully be a little more benign than if they were selling some of those lower cost ones because they've purged the account of some of those lower cost shares. Does that
yeah.
make
There's
sense?
just ultimately more control, and that is something that can happen with mutual funds too. For example, where if say the mutual fund needs to make a distribution for redemptions, they can choose what tax loss to sell in there as well. And so that is something that's possible. That was with Vanguard. That was one of the benefits that they had is they could basically cross between the benefits of the mutual fund and the benefits of the ETF there. And so they kind of best of both worlds. Um, but yeah,
And like the way we're describing all this stuff, like we're a lot of these are fringe benefits. It's not like, oh, if you're in an ETF, you
exactly.
have zero taxes. If you're in a mutual fund, you're
Yeah.
going to be hammered over the head with taxes. No, we're talking like maybe a 1% difference per year, like per fund. But hey, compounded over a lifetime, that can add up, especially for those of you who have larger account balances in a taxable account. If it's in an IRA, like doesn't matter. Those are tax sheltered. But in a taxable account, especially as you start moving up the wealth ladder, like those little minuscule differences, that could be a few $1,000s or more in taxes per year that
Hmm.
you could avoid potentially by being in a slightly more tax efficient vehicle.
Yeah, realistically, from a tax perspective, a mutual fund or ETFs on the margins are a little bit more efficient. But when you're talking about index fund to index fund, it's the difference is so small, just because the mutual funds don't pay very many capital gains distributions anyway. On the index side, it's really when you see the real big differences, it would be those active mutual funds that could be paying out. I've seen up to 25% in a year capital gains distribution, which is huge. And
Mhm.
so that's one of the main distinctions is active versus passive on the mutual fund side.
Yeah, so depending on your objectives, you may want to have those more active, specialized mutual funds in a tax sheltered account like an IRA, so you don't have to worry about capital gains distributions. That's where Vanguard got a lot of heat a couple years back because they processed a lot of capital gain distributions from their target date funds, and all of their investors who had target date funds in their taxable accounts were like, "What the heck? Why am I paying all these taxes? I didn't sell." It's like, well, you don't
Yeah.
have a this
That's a
fund.
terrible idea. Why would you put a target date in your brokerage account?
Well, yeah, if you don't know any better, but it's like this isn't designed to be managed from a tax standpoint. It's designed to be in a retirement account.
Hmm.
So you want to
For
make sure
sure.
asset location, use more tax efficient funds. There are tax managed mutual funds specifically, even ones that track indexes. Like that's one thing with a small cap index, there is a lot of turnover. So even if you're in a tax efficient fund, like there's still going to be some capital gains distributions from year to year just due to the turnover. So there are
Exactly.
specialized, index funds that will also be managed from a tax standpoint. So it's kind of dual objectives. One, try to mirror the index, but also try to minimize taxes from year to year. You can't completely avoid them, but there are ways to do it more efficiently. And those funds exist. You just got to make sure you're using the right ones in the right accounts.
Hmm.
Yeah. I know there's like some tiny like expense ratio differences, like for example, between the Vanguard 500 index and the Vanguard 500 ETF. And again, this is like very much on the margins. Like the differences are so small that they may make a difference over a long period of time, but not that big of a difference over a short period of time. But is that just because Vanguard has to handle the trading like within the fund, whereas with the ETF they are less involved and don't have to do as much work? Like what's the reason for the expense difference?
I don't actually know that. I do know
Yeah,
with certain within the ETF space, something to mention is that some of the most liquid ETFs out there, some of the biggest ones, tend to be more expensive, and there's a premium built into those. Where there are also there are equivalents from the same companies that maybe aren't used quite as widely, but they're still pretty large that have expense ratios that are half or even less than half.
interesting.
Where, for some of those most liquid shares, it's because it's institutional money that's going in and out of it. And so they want to have the most liquid option available. But for if you're buying 5 shares here or there, it really just use the cheaper fund.
Hmm.
Now, speaking of tax efficiency, so if we had to pick one, sounds like ETFs, all else being equal, might be slightly more tax efficient than mutual funds. So maybe go with the ETF in that scenario if you had to
Hmm.
choose, but probably not making a giant difference for most of you. If we really want to get tax efficient, we could start owning individual stocks or bonds,
Hmm.
which I think we did an episode a little while back on direct indexing, and how that can be a more tax. But let's dive into that a little bit. So if we really want to be optimized from a tax standpoint, what's a good way to do that?
I mean, realistically, if you hold individual stocks, if you're trying to kind of go for low tax, dividends you pay higher taxes on dividends than you do on growth. So typically we take more of a total return perspective where, sometimes people say it's like, hey, let's try to get as much yield as we can. Yield means taxes. It's just kind of built into it, where you pay income tax rates on dividends, you pay capital gains tax on the gains. And so if a stock appreciates, you say you have a growth oriented stock that appreciates and doesn't pay out dividends and you just hold it, you don't pay taxes until you sell it. Where, for some of those dividend payers, you'll pay taxes along the way. And so if we're trying to optimize for that could mean, you want to lean a little bit more into the growth side of things. Um, that's just kind of a main way that I look at that. But I don't know if you have anything you want to add there.
No, yeah, I think that makes total sense. So if we're trying to optimize for taxes in a taxable account, don't own high dividend paying stocks because that's going to be the opposite of what you're trying to do.
Hmm.
And with dividends, I think a misconception is, oh, dividends, I'm getting income. That's better. It's like, well, when a stock issues a dividend, they lower the share price by the amount they paid out in dividend. Whereas if they just held that money internally, like it's not like new value is being created out of thin air. It's like, all right, we're passing this money to you. Now our company is worth less. And then you reinvest
Hmm.
the dividend and you still have the same amount at the end of the day. It's just you had to pay some taxes on that money that you weren't keeping. So yeah, to your point, you're arguably better off having lower dividend paying stocks and ETFs, mutual funds, whatever, and just selling the shares when you need the money, because then you would pay long-term capital gains, assuming you held it for more than a year versus
Hmm.
ordinary income on the dividends. The other thing you can do, like, I mentioned direct indexing. All right, we can try and replicate an index rather than owning all 500 stocks on the S&P 500. Let's buy like 150, 250 of the lower dividend paying ones, the bigger names that'll largely replicate the index, So we're being a little more tax efficient that way, but then we can also isolate winners and losers and harvest at the individual security level from a
Hmm.
tax standpoint. And it's not uncommon for a direct indexing strategy to finish the year higher in value, but produce a tax loss on paper for you. So you can
Hmm.
actually, save a couple bucks in taxes while still seeing growth in your account.
Yeah.
I guess anything you want to add there?
Yeah, I'd say generally speaking, when it comes to taxes and minimizing taxes, the more levers you have to pull, the better. And so, if you go from, you kind of can go down the chain where, the simplest account is a target date fund or, a total stock market index fund. But there are no levers there. You're just on one fund and there's nothing you can do. The next level down is to, build out your sectors or build out large cap, mid cap value growth, things like that. And that gives you levers to pull where if growth is down, you can sell the growth and tax loss harvest. Gives you more levers. As you move into stocks, it just gets exponentially your options grow exponentially. And so really it just gives you the ability, as Corey mentioned, to um, harvest more positions and you could have a year where the account is up, but you actually realize a tax loss. Um, so
And we're not big advocates of individuals investing in individual stocks, even like advisors, trying to trade individual stocks for their clients and quote unquote beat the market or because that's good luck. It's a tall task. What we're talking here is we're more or less creating your own ETF or mutual fund. We're trying to replicate the index returns
mhm,
over the long run. And we at Finity don't do this internally directly. Maybe one day we will as technology improves, but like there's third party companies that specialize in this and for a small cost do a fantastic job. To where you're essentially replicating the index returns over time, like a index ETF or mutual fund would do. But like Zach said, you've now instead of having one lever, you potentially have several hundred levers to pull to harvest losses from throughout the year and compound
mhm.
it over time. That can really add up from a tax efficiency standpoint. The other thing you can do if we're looking at income, municipal bonds, like there's some neat stuff you can do there, either within a
One thing
municipal
about
bond
the
fund.
direct indexing before we
Oh, go
move on
ahead.
is that you'll
Yeah,
just need like a big chunk of money to do it. You like
for
you can't do
sure.
it if you have $5,000 a month
Mhm.
unless you save your $5,000 a month for a long time and have a big chunk so you can just throw a big chunk in all at once. Because buying individual companies, like you need a substantial amount to get invested and started in a strategy like that if you want to be well diversified. But
Yeah,
Mhm.
you typically
yeah,
need like 100K plus just to buy one direct index replicator.
right.
Um, so yeah, good point there.
One thing I'd add on both ETFs and with just owning equities themselves, that as a benefit over mutual funds is also that those you can also trade options on those. So, for example, if you own ETFs, you can write covered calls on them for increased income, or do other strategies around that. Where with a mutual
Hey,
fund,
Zach, what's a covered call?
Investing 301. Let's get
that's a
into
great
it.
question. Yeah, moving into that, so with a covered call, basically you have options. So a call option is essentially it's the right to it's a call is a right to buy, and so basically you could say, hey, you can pay for this option that says like the stock is currently trading at $100. I want the option to buy it at 105 in 6 months. So if in 6 months the option goes to $120,
The
you could
stock
go
goes to
back and
120. You mean? Yeah.
the stock goes to 120, you could buy it for 105. If the stock doesn't go to, if it ends below 105, then your option just expires worthless and you just basically you paid for the option to have it, but it didn't work.
But you don't want to
You
buy it
can
at 105 because it's worth less than that right now.
Exactly. So that's where you just
Yeah.
let it expire and it's a cost, it's just a cost. And
Yeah.
so to flip that around, you can also sell calls. So you could, if you own a stock that's trading at 100, you could sell the option for somebody else to buy it from you at 105, 110, or whatever. And you collect the premium from that. So you're basically just selling that option. You collect the premium, and then really it depends on what you're trying to do. You just hope that it stays under that amount, and then as long as it stays under that amount, you just kind of collect the yield from it, and that can increase the income from a position. You can choose at the thresholds for where you want to write that call at, based on your how much you want to how comfortable you are with the idea of it being sold. So you could write really far out of the money, or you could do 120 or something like that just to collect little bits of yield. So it's just an option for people that if they're trying to increase the yield in a portfolio, where you have that if you use ETFs or stocks, but you don't have that with mutual funds.
So like I own an individual stock, I own an ETF. Be like, hey, I don't plan on selling this, but I've got a lot of it. I'm gonna sell some call options so that if the
Mm,
stock or ETF rises 25% over the next year, the
hmm.
person I sold the option to will exercise their option and I have to then sell them my stock at a lower price. But assuming it doesn't rise by that much, I'm just going to get a couple bucks from selling them the option.
Yeah.
And odds are it's not going to go up by that much. So I'm going to just make a little extra money on my stock. Now, don't try this at home. This is like
It's investing 301.
yeah, more
Yeah.
people I think end up losing money over trading options relative to just buying and holding normal investments. But if done correctly under certain circumstances, it can also work. Um, you can use it if you have a large position. Like let's say you worked at a tech company or something, and you've got a lot of stock from working there. Like maybe you got $1 million worth of this one company's stock, and if you sold it all today, that'd be a pretty big tax hit. You want to try and divest it over time. You could write some options on that stock, provide some gain loss collars essentially to work your way out of it. So if the price drops, you sell some of it. If the price rises, you sell some of it. Um, am I
Yeah.
making sense here?
Yeah, I think that makes sense. I think that to explain what a caller is, we described a call option. You also have put options. So a put is a right to sell. Works the same way. If I buy a put option, it gives me the right. Say a stock is trading at 50, goes down, and I buy an option for 45, and it drops to 40. That means that you have the right to sell it to somebody for 45. So it essentially it's a risk mitigation. It's insurance on a stock position. You have to pay for that insurance. So what sometimes people will do is they'll buy a put option and sell a call. So essentially it caps your gains, but then it also caps the losses. And so that's kind of what Corey's talking about here.
So the
Is
net
the
cost
cost
to
of
you.
options considered like a capital loss? Like, can it reduce your capital gains, or how does that work?
With, I guess, any proceeds that you get from options are treated as
Capital gains.
capital
But what
gains or
about the money that
losses.
you spend on options if you purchase options?
That would be a capital that would be a capital loss. It depends on what
That
happens
just
to the
increase your
option in
cost
the end.
basis, essentially.
Yeah.
Maybe. Yeah.
Okay. Tax
Ooh, we're
planner
learning
question.
things.
Um, so yeah, investing 301, maybe like 401 or 501 when with these
hmm
call options on. So yeah, that's something I guess roundabout way you can do on ETFs, can't do on mutual funds.
Hmm.
So
If
as
you want to get
clients,
real fancy.
well, and there can be scenarios where it makes sense. If we just want to try and protect the downside, make some more yield on our large positions as we're in retirement. There can be it can make sense to do that. And then there is a more common securities backed lending strategy. Oh, I'm blanking on the name. Is it block? Uh, like instead of buying a securities backed line of credit on your account or
hmm
opening one up, you basically do it through option strategies, and it's a lower cost way to ultimately create loans.
hmm
Why am I blanking on the name here? Let me do some Googling.
I don't know what that is. Yeah.
This is great
With
for
some
audio.
I know with some of these strategies, depending on the broker, there's potential to essentially, you could buy protection on your holdings and then, take out a margin loan against that and then invest it in another, you can invest it in the broader market. So that's for a highly concentrated position. So say you owned, you know, like $100,000 or say $1 million in Microsoft and you were trying to, diversify, you
Mhm.
could protect that position, take a loan out against it, and then you know, buy
S&P
the the
500
the
or
broader
something. Yeah.
market. Yeah.
hmm Yeah.
What about muni bonds for tax efficiency?
Muni bonds. I mean, I think that if you were to build an overall building a ladder of fixed income, where I think the main thing with individual bonds to keep in mind is that those prices can change. And so if you're holding these bonds to maturity, and you're essentially just clipping the coupons there, that can be a good way to essentially like minimize, essentially lock in the income stream. Um, Overall, we're gonna have to cut this part, I think. I can't
Nah, we don't edit.
the
Well, you
the
can get some tax free at the federal and state level if it's a state specific bond. Um,
yeah.
and if you
I wasn't sure if
bought,
you were getting into individual munis or
I
like
guess
a
if you have a muni fund, the share price is going to fluctuate,
yeah.
but you're still going to get tax free income.
Yeah.
Um, whereas if you
I
owned
think
individual munis, if we want, I guess we can get into both. Like you're locking in that income for however long the duration is on the muni
yeah.
bond. So like if you buy a basket of 20-year muni bonds and that are state specific to your state, the interest is both federal and state tax free. And depending on your tax bracket, that could be a
Yeah.
little more um, uh, beneficial than owning a taxable bond and a little more predictable too. It's like, all right, I'm getting my 5% tax-free income for the next 20 years. Sounds pretty darn good. It's never going to be more, never going to be less. And then at the end of 20 years, I get my principal back, assuming the municipality doesn't go bankrupt. Um,
Hmm.
so it's just a more predictable way to create, uh, some tax-free income. It really only makes sense if you're in a high tax bracket
Yeah.
because the interest rates on munis are typically lower than corporates
hmm
and
Hmm.
um,
And the main risk to point out there is that, 5% may seem attractive now, but who knows what rates will be in 20 years. And
true.
so that is the risk you run with individual bonds where you'd want to build out kind of more of a laddered approach where you have maturities happening over time so that you can reinvest potentially to help reduce any risk there.
Interest rate risk. Yeah.
All
Cool.
right. I think this is over all of our heads, but box spread loans, where you're essentially creating
What?
calls and puts on your positions. Um, and if it's done right, you can essentially create loans for yourself with fixed payments and expiration dates that could be more a lower interest rate than a typical securities backed line of credit. And the
Mm.
interest that you pay is considered a capital loss on the
hmm
options. So tax deductible on capital gains. I think there's companies that specialize in this because this isn't a try it at home strategy. But you sell a call, buy a put, buy a call, sell a put on the same underlying asset, all with the same expiration. So it locks in a fixed interest rate. Um,
Sounds
and then
terrible.
you borrow against your portfolio without selling securities.
hmm
Hmm.
So you could do that on ETFs and individual stocks where you probably can't
Yeah.
do it on a mutual fund. Maybe you could do it on mutual funds, but it'd have to be the underlying asset. I don't know.
Typically with the trades, well, I guess it depends there. Yeah, sometimes in situations where if for a covered call, for example, a lot of times you need to the way that it's logistically set up, you need to actually have the underlying security in your portfolio, or it'd be called a naked call, where those are probably one of the riskiest trades out there. Um,
Yeah, you have to own the underlying security to do this.
yeah,
So
Yeah.
this would be like you got a sizable account, you have a lot of capital gains, you need some money for a home renovation. You could pay 6% interest on a securities backed line of credit, pay it back over the next couple years. Or if it's done right, you might only have to pay 4% interest on a box spread loan.
I think it's one of those things where it probably only makes sense to mess around with it when it's on like a big scale, where that
For
like
sure.
5%
Yeah.
versus 4% makes a big difference. Like even on $200,000, I'd be like, let's not mess around with this.
The
This
2%
is
difference. Yeah. So maybe if you're like
exactly.
talking 7-figure loan amounts, like, hey, I've got a $10
Yeah.
million account. I want to buy
Right.
this $2 million house. I don't want to take out a
Right.
mortgage. I can pay it
Yeah.
off in 5 years. Let's do this box spread loan at 3.5% interest. Okay.
Yeah. I think
Lock
with
in the
any of these more
interest, lock in the
complicated
term.
strategies, yeah,
Yeah.
I think with any of the more complicated things, it makes sense at like these big dollar amounts, like, your
Hmm.
$200,000 brokerage account. Like, let's not be too wild here. But
Hmm.
yeah,
But no, thinking ahead, like if you're teeing
yeah,
yourself up for success, all right, kind of
yeah,
working on adding more ETFs to our portfolio. So when we do have those
mm-hmm.
seven-figure account balances, we have some
There's more
more options
flexibility.
available to us to do some of these more advanced strategies if called for. We don't just do it because we can. Um,
Mm-hmm.
like we do it because there's a specific need and reason. And hey, we have a more cost-effective, tax-effective, whatever way to execute this objective. So
Yeah. I think that if you're doing any of this stuff on your own, don't overthink it. Mutual funds and ETFs can both serve a purpose. They're not going to be dramatically different. ETFs, it sounds like maybe like a little bit more tax efficient, especially in brokerage accounts and non-retirement accounts. But generally, they might be a little bit more work depending on if you're able to buy fractional shares or not. You may end up with some additional cash on the sidelines if you don't have someone actively managing it. So just lots of things to keep in mind.
Yeah, to kind of tack on for myself, I'd say that,
Mhm.
in a lot of cases, mutual funds and ETFs are very similar. It's really, what are the purposes of what you're doing? Do you want the extra flexibility? Is that worth it? And then also, what's the underlying that you're buying? Is it something you can buy in mutual fund form? A lot of times with specific sectors or, areas of the market, there aren't mutual funds for them that are indexes, and so there tend to be a lot more ETF options available. For example, if you want to buy like an international value fund or something like that, your mutual fund options might be limited in the index space. And so just looking at what you're trying to accomplish, and I think that's one of the main determinants there.
I feel like I've seen that on the ESG side too, like the environmental social governance side, where it seems like there's more ETF options than mutual fund options in some of those spaces,
Yeah. I
especially
mean,
for the indexes. Yeah.
the way it built out was originally, when mutual funds started, they were all active, and then index funds came later, and then ETFs kind of came along. And
Hmm.
so, that's that with newer creations, so like ESG, a lot of the new stuff is actually in the ETF space, where you have a lot of legacy mutual fund positions and other, active
Right.
funds.
like some of those more
Right.
obscure indices that are kind of newer, like a cybersecurity index of cybersecurity tech companies. All right, more likely you're going to find that in an ETF wrapper than a mutual fund wrapper. Um,
Exactly.
the cannabis
I
funds,
know. I was
they're
thinking
all
about that
ETFs,
too.
not mutual
Yeah.
funds.
Yeah.
So anything that's newer, more likely an
Hmm.
ETF has been created to invest in that than the legacy mutual funds.
Yeah,
Fun,
the
fun.
the market's definitely going that way.
Well,
Thanks for
super
joining
helpful,
us, Zach.
Zach.
Yeah.
We'll bring you back again in 5 years.
Yeah, that sounds like a plan.
When we're still recording the same podcast.
Yes. So yeah, who knows what we'll be talking about then.
Yeah.
Yeah.
Fun
Ooh.
times.
Okay.
Well,
Line
thanks
it
for
Stock
up.
listening,
spreads.
everyone. We'll see you next time.